Let us now actually understand the rules for calculating the tax base of a liability. Liabilities can actually be of two types. Liabilities can be of two types. The first type is liability could be in the nature of accrued expenses. It could be in the nature of accrued expenses. For example, let us say I incurred a bonus and I have actually provided for that bonus. All right, the bonus will actually be paid in the next year. Therefore, I create a provision for bonus in the current year. That is a nature of accrued expense. You incur an expense and you create a provision for it, and you are actually going to pay that in the next year. That is an example of accrued expense. The other type of liability could be a revenue that is actually received in advance. A revenue that is actually received in advance. The journal entry for revenue received in advance is typically bank account debit to advance. All right, so what has happened is you have to actually sell goods in future. You have to sell goods in future. For that, you're actually collecting an advance today itself. All right, so you have to sell goods worth 1 lakh in future. You are collecting 1 lakh of advance today itself. The journal entry is you will record bank account debit a receipt of 1 lakh, and the credit will not go to sales because the goods have not yet been delivered. The credit will actually go to advance. In the next year, let us say in the next year, when you actually sell the goods, you are then going to actually record another journal entry, which would be advance debit to sales. All right. So basically, in year one, you are actually crediting advance, you're crediting advance, and you're parking it as a liability. And in year two, the liability is then being moved to sales. Once the goods are delivered, you will then recognize sales. All right. So these are the journal entries in case of revenue that is received in advance. All right, so liability can be of two types: accrued expenses or revenue received in advance. For accrued expenses, the journal is basically expense debit. You debit expense and you credit accrued expenses. All right, and in year two, the accrued expenses are basically paid off. So you will debit accrued expenses and you will credit cash of whatever the value actually is. All right, so basically these are the journal entries. Liability could be of two types: one accrued expenses and the other is revenue received in advance. So we will actually have the rules for tax base for accrued expenses and tax base for revenue received in advance. We're going to have slightly similar only but different rules for accrued expenses and revenue received in advance. All right, in assets also we had two types of rules: one where future economic benefits was taxable and the other where future economic benefits was actually not taxable. Over here, liabilities are also classified into two: accrued expenses and revenue received in advance, and we are going to have rules for tax base of accrued expenses and tax base of revenue received in advance. Tax base of accrued expenses. Tax base of accrued expenses is calculated as the tax base is going to be equal to carrying amount less amount that is going to be allowed as a deduction in future, amount deductible in future for tax purposes. It's going to be carrying amount less amount deductible in future for tax purposes. The tax base will be the carrying amount, as which means basically amount as per accounting balance sheet less the amount that is going to be allowed as a deduction in future for tax purposes. Let us actually quickly do some examples for this and then we'll come back to revenue received in advance. Let's do some examples for this and then we will actually come back to revenue received in advance. Let's take a look at example number 12. All right, example number 12 is something we actually did using the logical approach. Let's actually now do it using the rule-based approach. Current liability includes accrued expenses with a carrying amount of rupees 100. The related expense will be deducted on a cash basis, which means 100 will actually be allowed as a deduction in future. All right, in the current year, I have a liability of rupees 100, which means I did not pay it in the form of cash. So will it be allowed as a deduction in year one? The answer is no. It will not be allowed as a deduction in year one. All right, but in year two, when I actually pay this 100, when I settle this 100, I will be allowed as a deduction because this expense will be allowed as a deduction because I've actually made the payment and therefore it will be allowed as a deduction on cash basis. Now, what is going to be the tax base? The tax base is going to be carrying amount minus amount deductible in future, minus amount deductible in future. What is the carrying amount? The carrying amount is going to be equal to 100. What is the amount deductible in future? The amount that will be allowed as a deduction in future is also, sorry, the amount that is going to be allowed as a deduction in future is also going to be 100. Therefore, the tax base is actually equal to 0. All right, we also have a tax base of equal to 0. We actually calculated this using the logical approach. Under the logical approach, what did I say? Under the tax books of accounts, expense will only be recognized when it is actually allowed as a deduction. Over here, expense is not allowed as a deduction in year one. It's only allowed as a deduction in year two. Therefore, in year one, there won't be any journal entry itself. All right, there won't be any journal entry. If there is no journal entry, the tax base is going to be equal to 0. The tax base is actually going to be equal to 0. All right, that was the logical approach, but the rule based approach is going to be carrying amount minus the amount that is going to be deductible in future. Now over here, if you recall how we calculated the deferred tax, for example 12, if you recall how we actually calculated the deferred tax, what we did is we start by populating the carrying amount of the liability. The carrying amount of the liability for year 1 is going to be equal to 100. Alright, remember in example 12, we had a carrying amount of rupees 100 on my accounting balance sheet. Alright, we then actually plotted down the tax base. All right, the tax base we have calculated now using the rule-based approach. What was the rule-based approach? Carrying amount less amount that is going to be deductible in future, amount deductible in future for tax purposes. Now, if you think of it, carrying amount was equal to 100. Amount that is going to be deductible in future for tax purposes is also going to be 100. Why is it going to be 100? Because this expense is going to be allowed as a deduction on cash basis. Expense is going to be allowed as a deduction on cash basis. Therefore, in future, I will be allowed a deduction of 100. Therefore, my tax base is going to be equal to 0. My tax base is going to be equal to 0. Now, if I calculate the temporary difference, if I calculate the temporary difference, I'm going to have 100 minus 0, which is equal to 100. I'm going to have 100 minus 0, which is equal to 100 itself. What was the formula for temporary difference? If you remember the formula for temporary difference, it was carrying amount minus the tax base. It was carrying amount minus tax base. If you notice, what is tax base? Tax base is again defined as carrying amount minus the amount deductible in future. Tax base is defined as amount carrying amount minus amount deductible in future. All right, temporary difference is carrying amount minus tax base. Tax base is carrying amount minus amount deductible in future. If you actually notice, this carrying amount and carrying amount are nullifying each other. This carrying amount and carrying amount are nullifying each other, and what you will be left with is the temporary difference is technically going to be equal to amount deductible in future. If you notice, what you're going to be left with is amount deductible in future. All right, the temporary difference is generally going to be the amount that is going to be deductible in future. Therefore, it usually when you have a liability, you will always end up with an amount which is deductible in future, and on an amount which is deductible in future, you will basically have tax savings in future. You will generally have tax savings in future. Therefore, I will usually have a deferred tax asset. All right, generally speaking, 99% of the times on the liability, you will usually have amount deductible in future, which is actually equal to, which will actually result in creation of DTA. I'm repeating myself. Carrying amount and tax base, the difference of carrying amount and tax base is temporary difference, but tax base itself is defined as carrying amount minus amount deductible in future. If you notice, this and this are nullifying each other out. So temporary difference can also be defined as amount which is deductible in future. The temporary difference is equal to amount deductible in future. For assets, the tax base was equal to amount deductible in future. Remember, for assets, the tax base was amount deductible in future, whereas over here for liabilities, the temporary difference is going to be the amount which is deductible in future. And typically for temporary difference arising on liabilities, deductible differences only arise, and as a result of that, you will usually create a deferred tax asset. When you're calculating the temporary difference on an asset, when you're calculating the temporary difference of an asset, you can either have taxable temporary difference or deductible temporary difference. But when you're calculating the temporary difference on liability, generally you end up having an amount which is deductible in future only, and therefore you would usually have a deferred tax asset. So generally you will have a deferred tax asset. You will have a deferred tax asset when you're calculating temporary difference on a liability. All right. So what are we actually doing here? Carrying amount less carrying amount minus amount deductible in future. Therefore, the two carrying amounts are actually knocking each other off, and temporary difference is equal to amount which is deductible in future. Now, if you also recall, I gave you an interpretation for assets. I gave you an interpretation for assets, which means I told you, like, for an asset, the carrying amount represents the future taxable income. Tax base represents the amount that is going to be allowed as a deduction in future. Therefore, temporary difference, I told you, is the net taxable profit or net tax deduction that I will have in future. That was the interpretation that I gave for asset. I had not shared the interpretation for liability with you at that point. I did not share the interpretation for calculating the tax base or temporary difference of a liability at that point. I am now telling you the interpretation. The carrying amount basically represents the outflow of cash that I will have in future. Carrying amount basically represents the outflow of cash that I'm going to have in future. Tax base represents the amount that is already allowed as a deduction. Amount that is already allowed as a deduction. Over here, in example number 12, the amount that was already allowed as a deduction is actually zero because the expense was going to be deductible on cash basis. Therefore, the amount that is already allowed as a deduction is actually equal to zero. And temporary difference represents the amount that I will get as a deduction in future. Temporary difference basically represents the amount that I will get as a deduction in future. The carrying amount represents the outflow of cash that I'm going to have in future. Out of that outflow, how much is allowed as a deduction is represented by tax base. How much is already allowed as a deduction is represented by tax base. The remaining is basically the deduction that I will get in future when I actually have the outflow. When I make the outflow, the amount of deduction that I will get in future is represented by temporary difference. And typically, temporary differences are actually usually deductible temporary differences on which we actually end up creating a deferred tax asset. We end up creating a deferred tax asset. All right. So that is with regards to the interpretation of temporary difference on a liability or creating a DTA or a DTL on liability. Let's look at example number 13. Current liability includes accrued expenses with a carrying amount of 100. The related expense has already been deducted for tax purposes. The related expense has already been allowed as a deduction for tax purposes, which means that in future, nothing is going to be allowed as a deduction. Since 100 rupees is already allowed as a deduction in year one, in future, nothing is going to be allowed as a deduction. So therefore, tax base will be equal to carrying amount. Carrying amount is going to be 100. Amount as per my balance sheet is going to be still 100 minus the amount that is deductible in future, which is 0. So therefore, tax base is going to be equal to 100. Tax base is going to be equal to 100 rupees. All right. Under the logical approach, if you wanted to think of this under the logical approach, what you would have done is in tax books of accounts, you would have actually recorded this expense on an accrual basis. All right. Because the expense is deductible on an accrual basis, you would have actually recorded this expense on an accrual basis. Therefore, in tax books of accounts also, you would have recorded the journal expense account debit to accrued expenses. You would have recorded the journal expense account debit to accrued expenses of 100. Therefore, if you prepare a tax balance sheet, accrued expenses would have actually appeared on your tax balance sheet also at 100 rupees. So carrying amount is also 100, tax base is also 100, and therefore you're actually going to have zero temporary difference. You're going to have zero temporary difference. That is with regards to example number 13. Let's look at example number 14. We did this already using the logical approach, but let's do it using the rule-based approach. Current liability includes accrued fines and penalties with a carrying amount of rupees 100. The fines and penalties are not deductible at all for tax purposes. All right, over here, fines and penalties are not deductible on payment basis or on an accrual basis. They are not going to be deductible on a payment or on an accrual basis. So therefore, the tax base, if you think of it, is going to be carrying amount of 100. Carrying amount is basically accounting balance sheet value of 100 less the amount that is going to be deductible in future. Deductible in future. Is there going to be any amount deductible in future? The answer is no. This is basically going to be equal to zero. All right. These penalties and fines are neither deductible on an accrual basis nor are they deductible on a cash basis. So the amount that is going to be deductible in future is going to be equal to zero. So tax base will be equal to 100 minus 0, which is equal to 100 itself. All right. So the tax base is going to be equal to 100. That is with regards to example number 14. Let's look at example number 15. A loan payable has a carrying amount of rupees 100. Repayment of loan will have no tax consequence. All right. Let us say I borrowed 100 rupees from a bank. When I repay the 100 rupees to the bank, I will actually have no deduction. I'm going to get no deduction because it's just the principal repayment, right? So tax base will then be equal to carrying amount minus the amount deductible in future. Amount deductible in future is going to be equal to zero. When I repay the principal, the amount that is going to be allowed as a deduction is going to be zero. So tax base will be carrying amount minus zero, which is going to be equal to carrying amount of 100 itself. So the tax base is going to be equal to 100 rupees. All right. So that is with regards to example number 15. Now let's actually come back to revenue received in advance. Let's actually come back to revenue received in advance. All right. We actually carved out two branches. Liabilities could be either accrued expenses or revenue received in advance. Now, the tax base for revenue received in advance is going to be carrying amount less amount that will not be taxed in future. Carrying amount less amount that will not be taxed in future. All right, for accrued expenses, the logic was carrying amount minus amount deductible in future. For revenue received in advance, it's carrying amount minus the amount that will not be taxed in future. What is the amount that will not be taxed in future? All right. So this is with regards to tax base of revenue received in advance. You take the carrying amount and reduce the amount that will not be taxed in future. All right. Let's come to example number 16. Current liabilities include interest revenue received in advance. All right. I received some interest in advance with a carrying amount of rupees 100. All right. So the journal entry that I would have recorded is bank account debit to advance. All right. So therefore, my balance sheet has got a value of 100 rupees. My balance sheet has got a value of 100 rupees of advance. Now, the related revenue was already taxed on a cash basis. All right. The amount of revenue, this has actually not been recognized as revenue in my accounting P&L. In my accounting P&L, in year one, I've only recognized it as advance. I will be recognizing it as income in year two. I will be recognizing this as income in year two. All right. Whereas what they're saying is for tax purposes, this has already been recognized as revenue on a cash basis, which means the moment I collected it, I actually have to pay tax on it. I have to pay tax on it. All right. So it was considered or it was taxed based on cash basis. Now over here, because it's already taxed on a cash basis, will I be further taxed on it in future? The answer is no. I will not have to pay tax on this in future. All right. Whenever I recognize this income in my accounting books, I do not have to actually pay tax again in future. All right. So the tax base over here will be carrying amount of 100 minus the amount that will not be taxed in future. What is the amount that will not be taxed in future? The entire 100, which is already taxed in year one, will not be taxed in future again. Therefore, the tax base is going to be equal to zero. I'm repeating myself. This 100 that has been received as an advance has been taxed on a cash basis. Therefore, it is again not going to get taxed in future. Hence, the tax base will be carrying amount of 100 less the amount that is not going to be taxed in future is also going to be 100, and therefore the tax base is going to be equal to 0. If you think of this on a logical approach, which is preparing tax balance sheet, the accounting journal was bank account debit to advance. The journal in the tax books of accounts would have been bank account debit to interest income. Because it is taxed on a cash basis, I am going to recognize P&L. I am going to recognize P&L on collection. All right. In accounting books, I'm going to recognize P&L in year two. Whereas for tax books, I am actually going to record this, or I'm going to actually have this taxed on a cash basis, which means I will record this P&L also on a cash basis. All right. Therefore, in my tax books of accounts, if you notice, there is going to be no liability. All right. I've recorded an amount in the P&L account. Therefore, there's going to be no liability, and hence the tax base of the liability will be the amount at which it is being carried in my tax balance sheet, which is equal to zero. There is no liability, which means that my amount in my tax balance sheet is actually equal to zero. That is the logical approach. This is the rule-based approach for example number 16. All right, so with that, we're done with example number 16 as well. Let's actually now look at example number 17. This was an example that we actually did already using the logical approach, but let's actually now apply the rule-based approach. A Limited has been incorporated recently and it incurred 1 lakh rupees on its incorporation. This amount has been charged to revenue in the very first accounting period. So I already expensed this entire amount of 1 lakh rupees right in the first year itself. The tax laws allow a deduction over a period of 5 years. All right, so over here, the carrying amount is actually equal to zero. We saw that this carrying amount is equal to zero. All right, because the entire 1 lakh has been charged to P&L right in the first year. Now over here, will I actually apply the rule of asset or will I apply the rule of liability? The reason I'm asking is carrying amount of zero means it's neither an asset nor a liability. It's neither an asset or nor a liability. So over here, should I actually apply the rules of an asset or the rules of a liability? The answer is you can apply any rule and you'll actually end up with the same answer. You can apply either the rules of asset or you can apply the rules of liability and you will end up with the same answer. I am, for the ease of convenience, I'm applying the rules of an asset. All right. Now, if I am actually applying the rules of asset, what does the tax base mean? The tax base means the amount that is actually going to be deductible in future, the amount that will be allowed as a deduction in future for tax purposes. Over here, out of 1 lakh, 20,000 is already allowed as a deduction in the first year itself. 20,000 is already allowed as the deduction in the first year. Therefore, the amount that will be allowed as a deduction in the future years is basically going to be 80,000. The amount that is going to be allowed as a deduction in future will be 80,000 rupees. Therefore, we are going to actually say that the carrying amount is zero, but the tax base is actually going to be 80,000. All right. The tax base of this asset is going to be 80,000 rupees. The tax base will be 80,000, which is 20,000 being 1/5 is allowed as a deduction in tax laws over a period of next 4 years. All right. So the amount that is going to be allowed as a deduction in future is going to be 80,000, which is actually equal to the tax base. All right. So with that, we are actually done understanding example number 17 also using the rule based approach.